Welcome back to Legacy Engineer, the show where we break down the strategies, structures, and decisions that separate short term success from enduring legacy. I'm your host, Scott Arden. Today's guest operates at the intersection of real estate, tax strategy, and long term wealth preservation. He's the founder of 1031 DST Group, a firm dedicated to helping investors defer capital gains, transition out of active property management, and reposition wealth into more strategic passive structures. With decades of experience in financial service and a deep specialization in 1031 exchanges and Delaware Statutory Trusts, Raymond DeWitt is known for simplifying complex strategies while keeping the bigger picture front and center, protecting capital, creating flexibility, and building something that lasts. Ray, welcome to Legacy Engineered.
Thanks for having me. Glad to be here, Scott.
Absolutely. Thanks for being on, man. Well, I know you didn't just kind of stumble into this niche. Can you kind of walk us through your journey and what ultimately led you to focus so deeply on 1031 exchanges and DSTs?
Yeah, I stumbled into financial services when I was in my early 20s, and it obviously worked out for me. And after years of always been at a few different firms, most recently a major bank in their wealth management, I just kind of got burnt out on being a traditional financial planner and also working for a major firm. And realized that all my clients that really have money, they've all made it in their business or in real estate. So why are they going to sell all that and buy mutual funds and annuities for me at the bank, right? And I got independent. I was kind of, be honest, I was having like a midlife crisis. I didn't know what to do with my career. I was sick and tired of stocks, bonds, and mutual funds and financial planning. And anyways, a guy walked into my office one day with coffee and donuts and wanted to talk to me about DSTs, Delaware Statutory Trusts. And so he brought me coffee and donuts. Come on in. And he started telling me 1031 exchange DSTs. And I'm like, I don't even know what a 1031 exchange is. That's embarrassing to admit, man. But 2 nights later, I went to a cocktail party and got talking to a guy. I didn't think much of it, I figured that, but I talked to this guy at the cocktail party. He told me how he had sold 64 properties over the last 18 months and wished there was some type of a REIT or something he could have 1031 exchange it to because he was sick of the terrible T's, the toilets, the tenants, and trash,
Right.
and paid a lot of taxes because he just didn't know what else to do with the money. And my head literally just exploded. It went, oh my gosh, I just learned about this 2 days ago. And the light clicked on. I said, this is what I'm going to do. I'm going to be the 1031 DST guy. And 10 years later, 1031 DST guy. So
The expert in 1031 DSTs, exactly.
yeah, and added on a lot of other, just anything that if somebody gets a tax bill generated, I have programs to help you, eliminate that tax bill, I guess you would say. So
Oh, yeah, everybody's always looking to reduce the taxes, keep more of that money as part of the estate for, for legacy purposes, if you will, right? I mean, that's everybody wants to pay less in taxes. That's for damn sure. I know that.
for sure. So
That's awesome. Well, so for our listeners who, may hear 1031 exchange and immediately think complex or intimidating, how do you explain what a 1031 exchange is and where Delaware statutory trusts fit into that strategy in real world terms?
So 1031 exchange is IRC code, IRC code 1031. I mean, but it allows you to sell your appreciated investment real estate and purchase another piece of investment real estate. And if you follow these rules, it's a tax deferred transaction. I do not process the 1031 exchange. I'm not a qualified intermediary, but I work with a lot of qualified intermediaries and investors to solve their 1031 problem. The challenges are for some people, you replace one headache with another. Like I like to say, if you're tired of the terrible teas, the toilets, the tenants, and the trash,
Right.
I'll turn them into what I like to say the good teas. I know you've heard this, but the tequila, the travel, and the tea times, right? So in a 1031 exchange, traditionally people sell a rental property, they go buy another rental property. This allows you to sell that rental property, get rid of the management headaches, and go into something that's truly passive, and it all is up to snuff and approved by the IRS.
Right.
And that came for the DST for short, but it's Delaware Statutory Trust, is a special type of real estate syndication that you can 1031 exchange into and go passive.
Okay. Well, that's awesome. Yeah. Again, always looking to simplify life, keep
Yeah,
the cash flow coming in. And I like what you said there, the three T's. What was it? It was tea times,
travel and tequila.
travel, and tequila. Love it. I
Yeah,
love it.
yeah. No.
Well, that's awesome. So, in your experience, who benefits most from, say, the 1031 DST strategy? Or are there common situations or life stages where this becomes especially powerful?
Yes, it is, and there's more than just the typical. There's several scenarios where a DST makes a lot of sense for somebody. The most common is you're retiring from being a land, you know, the property management headaches, or maybe you just want to downsize and manage less properties. Even if you have a good property manager, there's still crap you got to deal with, as anybody who owns real estate knows. So that's an obvious one. Baby boomers are eating this product up. It's the hottest financial tool out there right now. I think it's really growing. Um, Other scenarios, though, is in an exchange, you only have 45 days to identify what you're going to purchase.
Right.
And oftentimes people can't find anything they like, or they thought they found something, and in day 43, the deal dies. It's real
Falls out.
estate, right? It happens. And the DST is a great backup plan. So I encourage qualified intermediaries, have your customers use a DST as a backup plan. Talk to me, talk to Ray. He'll help educate you. Other option is if you have boot or money left over. It's called boot in the industry, believe it or not, by the IRS, an exchange, taxable boot. Say you sell a property for $2 million and you find a property you love for 1.75 million. What do you do with the other 250 grand? Well, most people pay 60 plus $1,000 in taxes and walk away. You can use the Delaware Statutory Trust to fully complete the exchange and not have to pay that taxes with the 250 grand. It's typically only $100,000 minimum.
Got it. Okay. Okay.
So,
I
and
was
we can
not
do
aware of
odd
that.
numbers. We can do odd because a real estate transaction is never 2 million exactly,
You're
right?
right.
It's
Right.
1.854 and 72 cents, after closing costs. So it's like, hey, we can take the excess a little bit, round it up. So,
Yep. That makes a lot of sense, and
yep.
that's great for our listeners to hear because I know that, we've run into those challenges where it's like, okay, well, I love this property. It's going to be a great cash flow producing property, but I can't roll all my money. What do I do? Do I, buy put it on another property or, what do I do with it? So that's why you're our guy when it comes to that. We work together when it as it relates to that and as we have clients that have those needs. So awesome.
I'll mention also if you fail, your exchange fails, it busts, you don't complete it. I can still help you do investments that will give you tax deductions that will offset those taxes.
Got it.
So
Okay.
it's not over just because it's over.
Right. Right.
So
Right. There you go. Well, so one concern investors often have is giving up control. So, what are the biggest misconceptions you see around DSTs, and how do you help clients evaluate risk versus, say, opportunity?
so control is definitely, if you want control, you're probably not going to be a customer of mine. I mean, these are passive. If you don't want the responsibility, you have to give up control. If you want control, you have to take the responsibility.
Right.
So it's just a fact of life. So if you're that person who's going to buy their property and still wants to manage the property, yeah, you're not going to be working with me unless maybe you've got some boot left over or something that happens. But um, as far as the risks, so we work really hard. My broker dealer, Rialto Wealth, we have a dedicated due diligence team, and what they do is they're out there to vet these offerings, right? They're researching, they're looking into the backgrounds of the principals, especially if they're a new company or there's a major principal change in a firm we work with. We're doing background checks. We're looking at the offerings. We're looking at the numbers. And we also make all of these firms go to an independent third party law firm that specializes in due diligence. And they have to pay these companies up front to do due diligence on the DST for example, on this specific DST. And so we use that in conjunction. Well, what does this independent, research firm think of this? And that's a requirement, pretty much industry standard. And, we're also heavily regulated by FINRA and the SEC. That doesn't guarantee anything, but it means that we're playing by a set of rules that you see a lot of these people advertising online or on the radio, 12% returns. Like, that, not gonna, mom always said, don't say anything bad if you can't say anything at all. So we'll just leave it at that. But yeah, very highly regulated. And yes, there is risk. It's real estate. But it tends to be very high quality. It's stabilized. So you're getting into an investment that's it's done. It's in place. If there's financing on the property, that's done. The inspection report's done. Oh, and there's a tenant in it, or there's renters if it's apartments. And it tends to be newer Class A, so we're not expecting a bunch of problems with the property. We always have reserves up front in case there is an unforeseen circumstance. So we try to reduce risk as much as possible for the customer. I do like to tell people these are keep you rich investments, not get you rich investments, right? So if you're looking to triple your money in 5 years, a DST may not be the best option for you. And there is risk. That being said, I like to consider it a little bit on the lower end of the real estate spectrum. So.
So with that being said, kind of given, current market condition, interest rates, and shifting investor priorities, how are you seeing people use 1031 exchanges differently today, say, than, 5 or maybe even 10 years ago?
Well, I think people learn about the DST now and they go, oh, I'm so done, and they list their property and they're off and running. I think, unfortunately, a lot of people haven't been educated on DSTs, and I hate to say this, I'm going to rip on the real estate industry, but real estate industry, you need a better job of educating your agents and your brokers, because there's a lot out there that customer will say to me, "Oh, where were you? I wish I met you 6 months ago. My agent didn't even tell me about it." The 31 exchange.
Right.
So I think the education is getting better. I know a couple of firms are making their agents take like DST courses and connect with the DST person so they have a resource for that. And I'm flattered I'm a lot of people's resources. But I think there's definitely more education. The internet, of course, and then now AI is people are really learning a lot more about this and have more information at their fingertips than ever before. I am in a niche industry, but this niche industry is getting pretty big.
Right.
So
Do you see a lot of people transitioning from, hey, I was a guru here and now I'm a guru over here?
I'm seeing more and more people try to get into the DST business. Some of the largest, like kind of wirehouse brokerage firms are. They're not going to be as good at it as I am, or a lot of my competitors who are independent. It's a very boutique kind of a business. It's very hard to do a $500 million offering as a DST. Let's just say that, and make it a competitive investment. So yeah, it's getting more noticed nationally with the bigger firms, but they still, I don't think, have figured out how to do it right.
Right. Well, and like you said, I mean, if it's something that a lot of brokerages are requiring their agents essentially to be educated on this, because you can offer more ideas and say, especially when you're a seller's agent, right? It's like, hey, have you considered this? What do you plan on doing around this capital gain issue or what have you? So, having an understanding of how a 1031 works and how to work a DST, I think is absolutely critical, especially, as people start to get more and more into real estate and expand what they're doing.
And it's becoming more and more common for private equity institutional to own real estate. And I'm seeing I'm seeing younger people than usual starting to use DSTs now. It used to be exclusively for the guy in his 70s, and now I've got a lot of clients who are in their 40s and 50s that are doing it. So, I mean, I do it myself. I have more DSTs than I do actual real estate.
Huh.
And that real estate, I think, is currently listed. Some of it is going into a DST. So anyway, I digress.
Gotcha. Well, that's awesome. So looking back over your career, what's one lesson from a deal, a client experience, or even a mistake that fundamentally shaped how you approach this work today?
Um, I would say debt, and I'm not talking credit card debt. I'm talking real estate debt.
Mhm.
Um,
Good debt, right?
yeah, well, it can be. One of the
Depends on how
superpowers
it's
of
used.
yeah, one of the depends on who you talk to, I suppose, but one of the superpowers of a DST is the ability to replace debt in an exchange. Um, So, for example, if you have a $2 million property and you had $1 million of debt on it, and you sell the property, now you've got $1 million because the loan's been paid off, right? I hope you follow my math. And
Yep.
I'm barely able to follow. That's why I use even numbers here. But so it is. So the IRS now requires you've got $1 million left. Well, the IRS says, look, you sold $2 million of real estate. You have to buy $2 million of real estate. People don't realize that. So I've got $1 million, Scott. What am I going to do? I guess I'm going to go get another mortgage.
Right.
Nothing wrong. I'm 50% loan to value. That's considered fairly prudent leverage, for an investment property. But there's a problem. Interest rates are really high right now. It's kind of hard to underwrite a deal with an 8% interest rate on a loan and make a cash flow. Also, maybe if you're a retiree, it could be hard to get that loan.
Right.
A DST, if it's embedded, the debt's embedded into it's non-recourse to the investor because the trust has it. So I invest or you invest that $1 million into a DST that's 50% LTV. I'm getting $2 million of real estate, a million of debt, a million of equity. I've satisfied my exchange requirements with the IRS, so no taxable boot, and the debt boot is the worst of all. Um, no taxable boot because I completed the exchange. But guess what? That $1 million mortgage is non-recourse. I don't have a mortgage payment anymore. There's a mortgage payment of the property, but my distributions are coming based upon my equity. But I get all the benefits of the debt, the depreciation, the interest expenses, all that stuff's passing through to me. Plus, when they sell the property, you're getting the appreciation. The bank gets their debt back. So it's a very powerful tool. Now, that being said, I have an investor come to me who has no debt in their exchange. I'm hesitant to talk to them about a DST that has debt on it because now they're adding debt to their exchange. So when that DST sells down the road, they're going to have to replace that debt. And I don't think a lot of advisors, DST advisors, there's some great ones out there, don't get me wrong, but there's a lot of them that don't really educate their clients on that. They're just selling them the product.
Mhm.
That debt is going to have a reckoning someday. Now, it may not for you personally financially, but it can affect your exchange, but it can financially. During COVID, we had a hotel. I'll give an example of a hotel in Nashville. I won't name names. Great hotel, very profitable, great cash flow. They had a mortgage. COVID hit. Nashville wasn't letting people stay in hotels. Back for almost a year, they could only operate 2 stories of this 11-story hotel. They couldn't make any money, but yet they have a loan with KeyBank. Um, Fortunately, this company did a great job of fighting and working and preserving the capital because they had the deep pockets to do so. But investors got no cash flow for almost 2 years from that.
Wow.
And fortunately, this company was very reputable. We do business with this company for years, and they stepped up and they worked with the bank. They restructured the deal, and now that thing is humming along and doing great a few years later. But we learned that that debt ended up being pretty bad. Um, so if people don't need the debt, I'm very hesitant to add debt to their exchange. I'm sorry if that's like a longer
No,
answer than you wanted,
no,
but
that's a great answer. That's a great answer. Perfect. Perfect. Well, awesome. So, we ask every guest this, and it's at the heart of this show. What does legacy look like to you? Not just financially, but in terms of impact, family, and how your work carries forward beyond you.
um, I think with what the work I'm doing with people for their legacy is one, I'm helping them keep all that money they'd pay to the IRS in their pocket. I'm working for them. So financially, I'm helping other people literally save a lot of money in taxes, but and these products are great for legacy planning because they pass so easily in an estate transition. They're
Right.
so easy to deal with, unlike real property can be, and they get the step up in basis and so for legacy, from a business standpoint, I think I help people every day improve the legacy of their family. For me, for my legacy, um, I hope that what I leave behind and young people I'm bringing up in the business of my kids, I hope they remember the things I've taught them. And because I live by a lot of mantras my father taught me that have served me well to this day. Hence, he's the reason I'm such a big involvement and donor to the Safari Club International Foundation, right? And I'm very involved with that because of my father. Um, who knows if my kids will pick up that torch when I pass on. But I hope that people will remember that I wanted to help people and I wanted to do good. So, and of course, they had some more money in their pocket. So I'm definitely more popular than a dentist.
I love that. I love that. Yeah, that's why I do what I do. I've built a legacy for my son and my granddaughter. It's my passion to really teach other people how to do the same thing, utilizing these various different strategies for wealth creation, reduction of taxes, and ultimately, building something that endures, that lasts, and really lasts that legacy. So I love it. Love it, man. This is a great conversation. Well, I want to thank you for joining us today and for breaking down a strategies that's often misunderstood but incredibly powerful when implemented correctly. Your insights highlight exactly what legacy engineering is about: making intentional decisions today that protect wealth, reduce friction, and support long-term vision. For those listening who want to or to learn more about Ray Dewitt and being in the 1031 DST group, please contact our office to schedule your complimentary strategy session. Thank you for tuning in to Legacy Engineered. Until next time, keep building with intention and engineering a legacy that lasts. Thanks, Ray. When implemented correctly. Your insight